Good morning, good afternoon. So this video will be on elements to a trade setup. This video should have been made after the market efficiency paradigm video, but it is still good that it is being made now, especially currently after the teaching of the order flow video, which is the previous video before this video. So what is elements to a trade setup? So first, the IPDA, the Interbank Price Delivery Algorithm, which is IPDA, it's an AI system. IPDA is an AI system, all right, that the central banks they use to program price. Before everything became electronic and digital, before everything became super electronic, it was open outcry and everything was done mostly manually. So the introduction to the electronic age changed everything, and when the world is evolving, the financial market most times take the forefront of that evolution. So that is how the birth of IPDA was, which is the Interbank Price Delivery Algorithm. So this algorithm system was employed by the central banks to use to deliver price efficiently, because now this will reduce the input from humans to its minimal. So that is why this IPDA was created. And the like every algorithm, like every computer program, there's basic principles on how those algorithm is being executed. And for the IPDA, there's four basic elements that constitute an IPDA system, which is it always starts from a consolidation. And after a consolidation, we have the expansion. Then we have the retracement. And finally, we have the reversal. We have the reversal. These four elements, this is the only criteria. This is the only phases in which the interbank price delivery algorithm will go to. This is the phases in which the IPDA will seek to deliver price. So first, before you employ these phases, you must first have a context of that trade idea. So what is the context? The context does involve your narrative, your bias in play. So from the beginning of this mentorship, there's one particular aspect that we've been always reiterating, we've been always talking about, which is the draw on liquidity, which is understanding where price is likely to go next. So when you have the context to your trade idea that this is where you would want price to go next, this helps you solidify your the phases and understand the phases in which you are in currently to understand the next phase, which price is most likely to go to. So, and each of these elements has its own specific reference point, which we use to understand, which we employ when dealing inside of this element. So for the consolidation, we have the equilibrium, the institutional order flow that is relevant for the consolidation phase is the equilibrium. Equilibrium is a PD array. We'll talk about this as we go further. For the consolidation phase, we talk about equilibrium. So when price is in a consolidation, engineering liquidity on both sides of the market. This is when price is in that form of consolidation, price will be engineering liquidity on both sell side and buy side and where there is large funds, where there is large amount of money, that is where price will be likely to jot to next. When price is inside of a consolidation, we make reference to the equilibrium point from that consolidation. Does that make sense? So, for example, for this, let's make use of the bodies for this. As you can see, price was trading inside of this consolidation. We are using these bodies to illustrate. When price was trading inside of this consolidation, we had this here, price indicating its willingness to go higher. Then price returned back to its consolidation, to the equilibrium of this consolidation. Just is being shy of how many? Being shy of 2 points. The low of this candle is 844.14, while the equilibrium is 844.12, which is about 2 points. This is forex, and in forex you leave more rooms for precision because each broker, each server has its own price delivery. So that is why these discrepancies that you see right here. So for the consolidation, you reference the IPDA tool to use is the equilibrium when price is in a consolidation phase, and the reference point for the expansion when price is in a form of expansion. After a consolidation, then you have expansion. After consolidation, you have expansion in price. And when price expands higher or lower, that is the market makers revealing their intended pricing model. So when there's an expansion in price, that is typically when, with your context in mind, with your context and your framework that you already have in mind, the expansion will reveal the intentions of the market makers. That is the market, when there's an expansion in price, that is the market makers revealing their intended move, their intended repricing model that they're about to use. So, and for an expansion in price, when you have an expansion in price, the IPDA tool to use is the order block. For example, for the bullish order block, the order block will be left at the equilibrium of the consolidation phase after the expansion. So when the expansion takes place, you note the order block which will be found at the equilibrium of this consolidation. So that order block will be of reference, will be a reference point for you to use to take price higher to your intended direction. So for example, this right here, this is a consolidation phase. So when price was in this consolidation from this low, let's use this. When price was in this consolidation, this level of consolidation, let's put this. So this is the identifiable range of its consolidation. So when price was at this consolidation, we had this other block here. So here we had this bullish order block. And as you can see, as I said earlier, the bullish order block will be found at the equilibrium of the consolidation which occurred before the expansion leg. And here you had the expansion to the upside. This is the market makers indicating their repricing model. What repricing model? Their repricing model to target this buy side liquidity here. This is messy. This is a messy template, but we'll make do. So their repricing model is them seeking buy side liquidity. They are seeking higher prices. So when we have this consolidation and your dawn liquidity is here and above, price goes through and through the liquidity pool, which is this buy side liquidity pool. So this is the context surrounding this trade idea. So when you have this consolidation, we are currently speaking on expansion, and the IPDA 2 for the expansion is the other block. So the other block will be left at the equilibrium of the consolidation phase that took place before the expansion leg. So after that expansion leg, you go into your price action and you note the last down close candle that was left at equilibrium. There's criteria to this. The down close candles inside of the equilibrium phase, inside of the consolidation phase at an equilibrium price point, you have this other block. So let's go over to the next. So for the retracement, we have liquidity gaps or liquidity voids, which is typically fair value. When the market is poised to go to retracement, this is the market makers indicating an interest to seek fair value, to seek fair valuation in price, to fill in every imbalances on price action, to have fair value for the smart money traders that were not participating in price action earlier. That retracement will be to seek fair value for them to enter their position. So for the retracement, we are interested, the IPDA 2 we are interested in when we are focusing on the retracement is the liquidity gaps and also liquidity voids. So the IPDA 2 of interest is the liquidity gaps and the liquidity void. After the expansion, we have the retracement, and the IPDA tool that we use in reference to a retracement is the liquidity gaps or the liquidity voids. So when price makes a one-sided direction, price comes down to fill in an imbalance or to trade back to price levels which were not sufficiently traded to when price was making its one-sidedness, when that expansion leg was taking place. So price will retrace down to seek fair value, to seek fair valuation in price. And fair valuation is, think of it in this sense. Fair value is at what point this asset class will be at for a bullish, when a market is poised to go higher, at what point that price of that asset, it is more cheaper to get than buying it at an expensive price. So price will go lower to seek fair value, to trade inside of those pockets of price action which was not sufficiently traded to, and it was left purposely by the algorithm. You see, this IPDA, because nobody believes it exists, there is nobody you can tell that this algorithm does exist. You can only show them that it exists, and they will have to go by themselves to see if what you have shown to them is true or not, without them going to see the machine by itself. Without them going to see this algorithm by themselves, they will never believe that this AI does exist. And for this reason, this is why the intelligence is limited. The knowledge of this IPDA is a limited understanding. And because the fingerprint of this algorithm is cannot be hidden by people that know its existence, because it cannot be hidden, it is easy to understand what it is likely to do next. Not always. You cannot be always sure. But this is why we always use a stop order while trading. So back to the retracement. So when price trades to a one-sided direction, price leaves an imbalance in price, and you expect when price trades lower inside of that imbalance, price is trying to offer fair value of price for smart money traders to participate in the marketplace at a lower price. So we had, after this retracement, after this expansion leg higher, we had a retracement in price action, and price filled the first half of this imbalance here. During your course of learning, you will understand when the imbalance is likely to be filled, when it is likely to trade just a tip inside of it, or when it is likely to trade to the midpoint of it. So narrative and understanding the order flow in play will help you understand to know when this characteristics is likely to take place. So for the last IPDA, for the last phase for the last element of a trade setup, you have the reversal pattern. So what is a reversal? As the name implies, when a reversal is seen in price action, this is the market maker indicating that stops orders liquidity has been taken on the opposite side of the marketplace, and price is willing to reverse. It is willing to trade. It is willing to deliver price action opposite to the recent liquidity pool that has just been taken. And the IPDA tools we make use of when dealing in a reversal pattern, it is we make use of the liquidity pools, which is the sell side liquidity and the buy side liquidity. Liquidity pools. So liquidity pools, you have the sell side and the buy side liquidity. So examples of a reversal leg is something like this. Examples of a reversal leg is this. This is a liquidity pool being purged on the sell side. This is a liquidity pool being purged. So when price purge this sell side liquidity, the algorithm will pair in these orders, these resting sell stops orders, to use as smart money entry for longs. So the algorithm will take this liquidity to facilitate the delivery of buy side, which is above here. So these are the 4 elements which IPDA does present itself, and there is each of these elements is each individual models. So you can be a trader that trades the equilibrium inside of a consolidation, or the other block which was left after the expansion, or you can trade a retracement which occurs after an expansion, which you use the liquidity gaps or the liquidity void, or you trade the reversal patterns, which is a sweep or a purge of liquidity pools. Each of these is an individual model. As smart money traders, you can have one of these, you can have 2 of it, or as you go into yourself in understanding how this algorithm is booked, you can then advance to understanding how to participate in all of these models. So, and this is the framework that you use to practice. So I would want you to go into a body of price action, looking at the marketplace like this, looking at price action like this. This is how the IPDA presents itself, either in a consolidation phase. After that consolidation phase, it goes into an expansion, and after an expansion, it goes back into a consolidation or a retracement or a reversal. It only does one of these 4 things, and once you have identified what phase the IPDA is currently executing, you can then understand what IPDA2, what institutional order flow pattern are you to use in that phase of execution. And these are the reference points in relation to the elements. That's all for the elements to retreat setup, and thanks for watching. Talk to you next video, and goodbye.